Hello, good morning all. Welcome back to Commerce Masters. In the last class, we discussed what is Dow theory and what are its major steps and all. And we have been discussing the security market theories. Today we will discuss efficient market hypothesis. This is another security market model or security market theory. Efficient market hypothesis. Okay. Efficient market hypothesis was founded by Roberts and was developed by Fama in 1970. Okay, the classic statement of the efficient market hypothesis is founded by Roberts in 1967 and Fama in 1970. An efficient market is defined as a market where the prices of the security quoted at any time are based on the fair and correct evaluation of all currently available information, which is almost freely accessible to all participants in uniform manner and time. Did you get the idea? Efficient market means the market is efficient with information. All the information related with the security prices are available to every investors. Okay, so if every investors are available with all the information, no one can cheat others. Every information is available to everyone, every investors. Okay, every information is available to every investors. So no one can make advantage of information, or no one can make abnormal profit out of this information, because all the information is available to everybody, and this information is discounted by the security price, or it is influence the security price. Okay, so security prices will be go down or go up on the basis of all the information. Okay, so efficiency means availability of information and how the security prices discounts this information. This is called efficiency. Okay, so efficient market model is actually concerned about the speed with which information is incorporated into security prices. So if information is discounted very fast, this will be very efficient market. Okay, so the efficient market hypothesis holds the view that in an efficient market, new information is processed and evaluated as it arrives, and prices instantaneously adjusted to the new and correct levels. Okay, so that means, for example, there are some securities in the stock market. For example, Reliance company security, and its price is 250 for today. You just think, just suppose the price of the Reliance company security is 250. This price will go up and will go down in this day, during the day, because of the demand and supply of the security, that you know. But what the demand and supply will be based on, or what is the reason for the demand and supply? Demand and supply will be changed on the basis of the availability of the information to the investors. One investor got an information that, for example, one investor got an information that the Reliance company is going to declare high dividend today, their annual dividend today, or they are going to announce big plans today. So the information, so the investor thinks that if that declaration comes into the market, the prices of the security will go up. Okay, the prices of the security will go up. Another investor did not get any such information, so he may not have any idea on the security prices. So the investor who got the information will buy the security now, expecting that the prices of the security will be increased once the information is announced, once the declaration comes on this dividend payment or some plans and all. Okay, the another information, another investor, he did not get any information, he may not have any idea on the movement of the security price, so he may buy the security or he may sell the security. So there is a information gap between these two investors. So that market is not efficient. That market is not efficient. So what is efficiency then? Efficiency means all the information which may affect the security prices are available to all the investors. So no investor can make any abnormal advantage on the security prices. No investor can make any abnormal profit. Okay, this is called efficiency. Got the idea? So the efficient market hypothesis holds that in an efficient market, new information is processed and evaluated as it arrives, and prices instantaneously adjusted to the new and correct levels. So the information will affect on the security prices, and security prices will be adjusted accordingly to the correct levels. Okay, so the information availability or the level of efficiency can be divided, categorized or classified into three forms. The first form is strong form of efficient market hypothesis. The second one is semi-strong form of efficient market hypothesis. Third one is weak form of efficient market hypothesis. What is strong form of efficient market hypothesis? A strong form of efficient market hypothesis is a market, or it is said to be in strong form if all information, both private and public, relevant to the value of a security, is quickly and accurately reflected in the current marketplace. Okay, all the information, whether it is private information, that is very private information related to the security prices in the company, it may be like that, or all the public information which is available to all the public. So all the private information and all the public information related to security prices, relevant to the value of a security, is quickly and accurately reflected in the current market price. Okay, whether or not generally known to existing or potential investors, whether it is known to the investor or it is not known to the investor, or it is unknown to the investor, that information, the private information and the public information, will be discounted by the security price. This is it. This is called the strong form of efficient market hypothesis. In this, what you have to remind, that all the information means all the private information and all the public information. Private information means all the private information available to the company only. So that information also will be reflected in the security prices quickly, means that security market is highly efficient in the sense of information. Okay. Then you see the second form is semi-strong form of efficient market hypothesis. Market is said to be semi-strong form in if all publicly available information relevant to the value of a security. Here, only publicly available information relevant to the value of a security is quickly and accurately reflected in the current market price. There is no private information available, or the private information is not quickly and accurately reflected in the current market price. Got the idea? The private information is private, and you might have heard of the term insider trading and all like that. Okay, insider trading means some information is available to the insider employees and insiders, and they may use that information to make profit in the security market. So such a private information may be only available to the private parties. Parties means the parties inside the company. Okay, so but if the company is going to declare one plan or some announcement regarding some big plans in the future and all, that information may not be publicly available to all, but that information may be available to the insiders of the company. So the employees, managers, or chief executives and all may buy security from the market before the announcement comes. They may buy a lot of securities, and after the information comes to the market or the information is announced, that price of the security will be increasing like anything. So these employees can sell that security at that time when the security prices increased after the announcement of the information. So that is called insider trading and all. So such information may not be available or quickly or accurately reflected in the security market price, means that market is not strongly efficient. That security market is only semi-strongly efficient, because the publicly available information is reflected in the security prices. Publicly available information is available to all the parties, and that is very quickly and accurately reflected in the security prices. Okay, the third form is weak form of efficient market hypothesis, means market is said to be in weak form. Market is said to be in weak form if all historical information relevant to the value of a security, no current information, only the historical information is available to everyone, and current or publicly available or privately available, no such information. The private information is private, and public information, it may be public, but that is not correctly and quickly, that may not be quickly reflected in the market. The public information, even though it is public information, that may not be reflected in the market very quickly. But the security prices are influenced only on the basis of the historical information. Okay, so the past information. If the market is such a market, that market is called in weak form of efficient market hypothesis. Got the idea? So efficient market hypothesis says that the prices of the security are not moving like anything. It does not show any trend or like that. It is not on the basis of the trend, or it is not on the basis of the company fundamental matters like that. But they say that the security prices may be like random. We are going to learn the random walk theory. The security prices are some like random walk. The random walk means if the information is available, that information will be reflected in the security prices. That is not on the basis of the past trend or like that, but the information will be affected. So if the negative information comes, the security prices will go down. If the positive information is coming, the security prices will go up. Okay, so efficient market hypothesis say that the movement of the security prices is based on the availability of the information. In the strong form of efficient market hypothesis, they say that all the publicly and privately available information will be reflected in the security prices if the security market is very efficient. Okay, and if the security market is not very efficient, or it is only semi-efficient, they say that the publicly available information will be quickly and accurately reflected in the current prices of the security. And if the market is very weak in the sense of efficiency, in information, they say that only pastly available or historically available information will be reflected in the security prices. You got the idea? So this is called the efficient market hypothesis. So this can be depicted in a picture like that, in the pictorial presentation we can say that like that. The outer portion show that you can see the dots are very near and they are very thick. Okay, so this is called efficient, strong form of efficiency. This is the availability of information. You may just think like that. So this is very strong form of efficiency. The dots are very near and very thick. The outer portion is very thick, and the second portion is the dots are somewhat show some social distance. So this is say we can say that this form is semi-strong form. Semi-strong form. The availability of the information is only publicly available information is reflected in the security market, and the social distancing in this this weak form of efficiency is very good, very high. So you can say the information availability is very less. Only historical information is reflected in the security market, security prices. So the security efficiency of the security market can be depicted with this picture. Okay, that's all. Thank you.